Hello, and welcome to 3 Slides in 3 Minutes for May. Expectations are improving. Here's something that gets missed when the headlines are all about war. Earnings expectations for the S&P 500 have been going up, not down. At the start of the year, analysts had a 2026 earnings pegged at $308 a share. Today, that number is $331. That's a 7% jump in roughly 5 months. And before you assume that's just borrowed from next year, 2027 estimates have climbed the same 7%. So this is real upward revision, not a timing shift. When you break it down by sector, three names are doing most of the heavy lifting. Energy is the standout, with 2026 estimates up a stunning 48%, which makes sense given oil at 110 a barrel. Materials estimates are up 15%, and tech is up 14%. The takeaway is simple. Even with conflict in the Middle East, the engine of corporate profitability is still running, and in some sectors is running hotter than it was in December. Stretch large caps? This slide is a warning, and you have to read it carefully. Overall equity positioning across the market sits at the 70th percentile, which is modestly overweight, but nothing alarming. If you stop reading there, you'd think positioning is fine. But when you look under the hood, the picture changes. Large cap positioning is sitting at the 91st percentile. Large cap tech is at the 96th percentile. That means investors are crowded into the same names in the same handful of mega cap companies, more aggressively than they have been in years. Crowded trades work beautifully on the way up, and they unwind hard on the way down. When everyone owns the same thing, there's no one left to buy when sentiment turns. We're not predicting a sell-off, but we're saying this is exactly the kind of setup that demands discipline around concentration, rebalancing, and making sure your portfolio isn't accidentally piled into the same trade as everyone else. Is the Strait of Hormuz open? You be the judge. Oil tells you what's really happening in the world right now. Brent finished this month just shy of $110 a barrel, up about $8, as hopes faded that the US-Iran talks or President Trump's trip to China would produce a real breakthrough. Inventories are tightening on every front. The US had another large draw, European stocks are at precarious seasonal lows, and the Strategic Petroleum Reserve is releasing oil at an all-time high outflow rate. Maybe most striking, gasoline crack spreads at the New York harbor are within striking range of the all-time high we saw during the 2022 energy crisis. So when you fill up this summer, expect pain at the pump. The longer-term picture is that the UAE is doubling its pipeline capacity around the Strait of Hormuz, and Canada is advancing a West Coast pipeline. The world is quietly rerouting around choke points, but that takes years. For now, oil stays elevated and energy stays a tailwind for earnings. If you have any questions, please reach out, and thank you.